You know, every now and then in the investing world, a number just jumps off the page. For Plains All American Pipeline, or PAA, that number is a massive 9% yield. So in this explainer, we're going to dig in and figure out if this is a golden opportunity, or maybe a trap for investors who are paying close attention. And there it is, a distribution yield of over 9%. Wow. I mean, to put that into perspective, that's often more than double what you'd get from a 10-year Treasury bond. It's the kind of number that makes you stop, right? It makes you ask, okay, what's the story here? And maybe more importantly, what's the catch? And that really gets us to the heart of the matter for anyone looking at this stock. A yield this high, it just doesn't happen by accident. We're talking about a company in the oil and gas industry, which, as you know, has these wild booms and busts. Plus, PAA has this really unique and, let's be honest, kind of complicated structure. So we're going to unpack that exact question. All right, so here's our game plan. First, we'll get a handle on its core business model. Then we'll look at this huge strategic shift they're making. After that, we'll line up the good, the bad, the bull, and bear cases, and we'll wrap up with a really critical look at the tax side of things, which you absolutely need to understand. So, let's get into it. Who exactly is Plains All American? Well, at its core, it's a company that's right in the middle of a massive transformation. They're trying to become a much simpler, more focused business in the U.S. energy world. But to really get where they're going, we've got to start with how their business actually works. So how does a company in the super volatile oil and gas industry create stable cash flow? It's actually a pretty brilliant idea. It acts like a toll road for oil. CPAA doesn't own the oil, it just owns the pipes and the storage tanks. It gets paid a fee for every single barrel that moves through its system. So it doesn't really matter if oil is at $60 or $100 a barrel, PAA still collects its toll. It's a model designed specifically for stability. Okay, so we've got the toll road idea down, but what does this thing actually look like? Let's take a peek at the massive network of pipes and tanks that make this whole business run. The scale here is just huge. We're talking about more than 18,000 miles of active pipelines. And this really shows you where their bread is buttered. The Permian Basin, out in Texas and New Mexico. This is the absolute engine of U.S. oil production, and it drives about half of PIA's entire cash flow. The assets they have there are, frankly, irreplaceable. All right, now for the plot twist in our story. PAI is in the middle of this big shrink-to-grow strategy. It sounds a little weird, I know, but it's a really bold move to get simpler and just double down on what they do best. In today's energy market, that's a pretty crucial move for survival and growth. Just look at the difference here. This really tells the whole story. The old PAA was a jumbled mix of businesses, including one called natural gas liquids, or NGLs, that exposed them to some really volatile prices. The new PAA is getting rid of all that complexity to become a pure-play crude oil pipeline company, focused completely on that stable, fee-based toll road model we talked about. It's all about less risk and more predictable cash for investors. And how'd they pull this off? With this number. They sold that non-core NGL business for a game-changing $3.75 billion. This is probably the single most important thing that's happened to this company recently. It's a huge pile of cash they can use to completely reshape the business. And they're not just letting that cash sit in the bank. Nope. Since mid-2022, they've already put about $1.4 billion to work on these smaller bolt-on acquisitions. Think of it like buying up the little local roads that connect to your main highway. It makes the whole system more efficient and more profitable. It shows they have a very clear plan for that money. Okay, so that's the grand plan. Now, let's put on our optimist hats for a minute and look at all the reasons why some investors think this story is going to have a very happy ending. So the bull case really boils down to a few key things. The company is successfully turning into a simpler, more focused operation. They have a rock-solid position in the most important oil field in North America, and they're doing all of this while cleaning up their balance sheet and committing to growing that payout to investors every single year. And speaking of that payout, this number is just absolutely critical to the bull case. It's the distribution coverage ratio. Imagine you're on a long road trip and you've got a full tank of gas plus another 3/4 of a tank in reserve cans in the back. That's kind of what this is. It means for every $1 PAA pays out to investors, it's actually bringing in $1.75 in cash. That is a massive safety cushion. But it's not all sunshine and roses. Every investment has risks. And for PAA, there are some pretty big clouds on the horizon. So let's flip the coin and look at the bear case. What could go wrong here? And these risks are very real. I mean, PEA's business is tied directly to how much oil is coming out of the Permian. If oil prices crash and stay low for a long time, drilling will slow down, and that hits PEA's bottom line. There's also execution risk. Management has a ton of cash to spend, and if they overpay for an acquisition, that could be a huge mistake. And then hanging over everything is the elephant in the room, the long-term energy transition. So how does PAA look when you put it side by side with the big guys in the industry? Well, take a look. You can see right away that PAA is way smaller than giants like Enterprise Products or EPD. And while PAA's yield is higher, its profitability, like its net margin, is a lot lower. One rating service even calls EPD's distribution safe, while calling PAA's borderline safe. So yeah, that higher yield definitely comes with a different kind of risk profile. Okay, finally, we have to talk about something that isn't about oil or pipelines at all, but it can be a total minefield for investors who don't know what they're doing: the tax structure. Seriously, this part of the explainer could save you a lot of headaches and money, so listen up. PAA is what's known as a Master Limited Partnership, or MLP. Think of it like a pipeline for profits. The company itself doesn't pay corporate taxes. Instead, it passes through the profits directly to investors. Now, that sounds great, right? But the catch is, instead of getting a simple 1099 DIV form at tax time, you get a much, much more complicated form called a Schedule K-1. So here's how it works for you. The cash you get is mostly tax-deferred, which is nice, but it's not free money. Every distribution lowers your cost basis, which means you'll owe more in taxes when you finally sell. You also have to file that complex K-1 form, which often means hiring an accountant. And you could even have to file tax returns in all the different states where PEA operates. It can be a significant administrative headache. And listen, if you only take one thing away from this section, let it be this. This is a direct warning. Be extremely careful about holding an MLP like PAA inside a retirement account like an IRA. If you do, it can trigger a tax nightmare called Unrelated Business Taxable Income, or UBTI. You could end up with a big tax bill inside your tax-sheltered account. This is a common and very costly mistake. Just don't do it. So, what's the bottom line here? Well, this quote from the analysis really just nails it. You've got a very high, well-covered payout and a clear growth plan for the next few years. That's the good stuff. But you have to weigh all that against the tax headaches and, more importantly, that very real long-term uncertainty that's facing the entire oil and gas industry. And that leaves us with the final multi-billion-dollar question. You're being offered a really big payday today, right now, in exchange for taking on the uncertainty of the future. Is that a trade you're willing to make? Is that 9% yield worth it? The answer, as always, is up to you.